I want to introduce our next set of speakers. John Longo is the professor of practice in the Finance and Economics Department at Rutgers University and the Business School. He's a chief investment officer at Beacon Trust and Strategic Advisors to Wellrex, a London-based fintech firm. John has appeared on CNBC, Bloomberg TV and radio, Fox Business, ABC News, and several other programs. He has been quoted in the Wall Street Journal, the New York Times, Fortune, U.S. News and World Report, the Harvard Crimson, and several other publications. He is joined by his son, Tyler Longo. The two co-wrote the book, Buffett's Tips, A Guide to Financial Literacy and Life, recently published by Wiley. Tyler is a high school student in the Princeton, New Jersey area. He is a candidate for the National Merit Scholarship, having scored in the 99th percentile of the PSAT. He also scored a perfect 800 on the math section of the SAT. Their keynote today is Lessons on Behavioral Finance from Warren Buffett.
Thanks, Ron. Thanks for everybody for staying with us. Hopefully you can see our screen. If not, let me know.
We got it.
So let me kind of talk to you about the motivation for our book. You might think it's a little bit strange that high school students writing a book with a professor. Well, I'm sure you all know that Warren Buffett kind of auctions off a lunch for charity every year for the Glide Foundation. And that lunch usually goes for several $1 million. Well, there used to be a backdoor way of seeing Warren Buffett, and that is for decades, he met with students about 8 times a year on a Friday for a 2-hour Q&A and then lunch. And I had the benefit of attending 4 of those Q&A sessions. There were some other schools there as well. In addition, at Rutgers, I teach value investing. So I've always been a Buffett fan. And in parallel, I was teaching my teenage son basic concepts of financial literacy. So I'm sure if there are parents out there, maybe they've gotten their kid a debit card or a teen credit card or a checking account, a college plan, and a brokerage account. So Tyler has all those things and was taking enough coursework that he was able to contribute to the book. So for example, he took the Intro to Business, Finance and Economics program for high school students at Columbia. He has a little brokerage account that's been trading pretty well. We can chat about that in the Q&A. So that's where kind of the talk comes from. And Buffett, as you probably know, has a lot to say about behavioral finance. So kind of let's get into it. Well, I think everyone on the call knows who Warren Buffett is, but just let me give you a 10-second bio to get us all on the same page. I think most people view him as the greatest investor ever. He's always near the top of the Forbes list of richest people in the world. His net worth recently was $90 billion, and that's even after giving $45 billion away, mostly to the Gates Foundation. In addition, those that follow his company, Berkshire, may know that he pays himself only a salary of $100,000 a year. If he ran a hedge fund, which he did a long time ago, but if he ran a hedge fund while he was running Berkshire, he could be worth 3-4 times that amount. What I think also is inspiring, especially for individual investors that are trading, is that Buffett has made his fortune by and large in Omaha, Nebraska, far away from Wall Street, working largely by himself. He does have some people like Charlie Munger that he bounces ideas off of. He has obviously people running his operating companies, but Warren Buffett doesn't need any advice to pick stocks and buy companies. Let's start out with what I think is his most famous quote, which I think is really at the heart of behavioral finance and why I think we're here today. Be fearful when others are greedy and greedy when others are fearful. I'm sure everyone's heard that. If not, I think it's a great quote. And I actually did some digging to see where that quote kind of came from. Well, you probably know, if you're a fan of Warren Buffett, that his mentor was Benjamin Graham. Benjamin Graham is known, among other things, as the father of value investing. And he wrote some best-selling books. One's called Security Analysis. Another that I think is better for the lay public is The Intelligent Investor. And in that book, he talks about the market as a pendulum. And this is a nice visual that I like and that I teach to my students, that in the long run, which could take years to arrive, the price may rest or arrive at the valuation models we teach in class, like the DCF or PV or EV to EBITDA. But in the short run, it oscillates between extreme greed, think about the internet bubble, and we can talk about what's going on with today's market, or extreme fear, like at the end of the Great Recession in March of 2009, and when the pandemic really hit the market in, let's call it March or April of last year. So this is a nice visual, and I think this is where Buffett gets his fear and greed quote. Tying it to some academic papers, we obviously had Richard Thaler with his keynote Q&A, and one of the first papers that I read he wrote was, does the stock market overreact? And the answer is yes. In the long run, it does. So what Thaler and his colleague DeBond did, who's actually his PhD student, is they sorted market performance into winners and losers over a 3 to 5 year period. That constitutes kind of long-term investing. And he said, what happens if I hold those winners and losers over the next 3 to 5 years? And you can see here in the blue font, the results are actually more interesting holding on to the losers, but the winners underperformed. So think about companies like Amazon and others today, that not that anything's wrong with Amazon, but if you find a basket of those stocks, according to DeBond and Thaler, on average, they might underperform the S&P by, let's say, 1.7% per year. What's more interesting is those stocks that were losers, that were beaten down, in the following 3 to 5 year period, they outperformed by about 6.5% per year. And for the advisors that are on the call, that would be a tremendous return for you and your clients. So that's the long-term part. That's what gets the pendulum to swing back to the middle. The short-term part, I think you can take the original studies on momentum. The best one is Jagadish and Titman. And they find that basically winners keep winning. And by winner, we kind of sort that on a 3 to 12 month basis. And roughly the alpha, if you go long the winning stocks and short the losing stocks, is about 1% per month, 12% per year. And obviously you can use leverage to enhance that return. So I think that gives you both the academic and intuitive insight into why that pendulum analogy may work. So you might say, hey, does Buffett actually practice what he preaches with that quote? And my response would be yes. First of all, if you don't know anything about the history of Warren Buffett, he was managing a small hedge fund after he finished graduate school back in Omaha. And I would say he first became known on Wall Street for putting 40% of his fund's assets in a single stock, American Express. Amex got caught up in a scandal. It's called the vegetable oil scandal, where they provided trade financing to a company called Allied Crude Vegetable. And the company basically committed fraud where they basically had, barrels of water and sprinkled salad oil or salad dressing on the top. So Amex, the stock went down over 50%. Buffett put 40% of his fund, and we know the rest of the story. Amex went up 5 times that amount over the next 3 years. More recently, in the Great Recession, when nobody wanted to touch financial stocks, he bought Goldman Sachs, GE, and later Bank of America. So that's kind of the fear part of Buffett springing into action. What about greed? Well, to me, the current market is probably closest to the Nifty 50, not the internet bubble. Nifty 50, if you're not familiar with that kind of bubble or craze, is that people at the time said, all you need is just to buy one stock and hold it forever. And there was a group of 50 stocks like McDonald's, Merck, a lot of the household names we own today, but they were trading at 50 times earnings and came back down to earth, especially in the deep 73, 74 bear market. So here's where it gets interesting. Buffett was running a hedge fund, making the equivalent, let's say, a couple of $1 million a year. And he had the ethics, as well as, I guess, the common sense to say, I can't really find any great values in the market. I'm going to close my hedge fund and return your capital. And if you want, I'm going to hang on to this holding Berkshire Hathaway. And we know the rest of the story, how that became his holding vehicle. So he did. He basically, when he saw greed, he closed out his position. Same with the internet bubble. People derided him as being out of touch, but he did not go wholehearted into any internet bubble stocks. And when the bubble popped in March of 2000, he really outperformed tremendously. His alpha was like 40% over those next 3 years. And who knows what he's thinking today? We just saw he added to Verizon, a couple of other positions, Chevron, but he's still holding about $140 billion in cash. So maybe that says something, and we can address this in the Q&A and as well as the segment after this. Another interesting academic paper, actually written by some practitioners, is called Buffett's Alpha. It's exactly what it sounds like, that these researchers from AQR, which is a well-known investment shop, try to drill down and see what actually is generating Buffett's alpha. And there are three factors. One is low beta, two is high quality. And if you put those two together, most people would kind of call that a moat. Good examples might be Coca-Cola, or more recent holdings of his is Apple. They would fall into that beta less than 1, high quality. And the third is that he does use a little bit of leverage, mostly from his insurance unit, but his Sharpe ratio is 2 to 1 higher than the S&P. And if you're curious, why securities without the quality underperform, there's an article in the journal Finance called Preference for Lotteries that explains that people kind of get a thrill from gambling, and they like the idea of picking the next Amazon, even though a basket of those securities tends not to do as well as the market. So with that, I'm going to pass it to Tyler, who's going to talk about some other behavioral elements of Warren Buffett and his investment strategy.
So first, consider the John D. Rockefeller. He's considered the richest person of modern times. If you adjust for GDP and inflation, he would have a net worth of $400 billion. That's more than twice that of Bezos or Musk. And to give you some perspective, here's a quote on the screen from Warren Buffett. "All families in my upper middle class neighborhood regularly enjoy a living standard better than that achieved by John D. Rockefeller Sr. at the time of my birth." And consider all the advancements since then, the rise of television, personal computers, the internet, the jet airplane. And the lesson here is, to be an investor, you must have a long-term perspective. So when Warren Buffett looks at a company, he likes to measure it in terms of intrinsic value. So the blue area on this graph represents future cash flows of a company. And if you divide that by 1 plus the discount rate to the power of time, that would result in this purple area, which is labeled present value of future cash flows. And another way to say that is intrinsic value of a company. A way to represent that mathematically is to take the integral of the purple graph from 0 to infinity of f of x, which represents whatever function you use to measure future cash flows, divided by 1 plus the discount rate to the x power, dx. X would represent time in this case. And if you divide that by f of 0, which is the present earnings, this could be used as a metric for optimism, similar to PE ratios. So Warren Buffett, he's not a big fan of Bitcoin. So why is that? He says Bitcoin is a mirage. It may be a better way of transmitting money, but is not money. And so he says Bitcoin doesn't really have intrinsic value to it. He says, in contrast, stocks, you get the cash flows from the companies, bonds pay interest, real estate, you could get rent from, and land could grow crops. So we're going to send out a poll for, you're going to answer, how much would you pay for this painting?
Max, if you can launch the poll, please. If it doesn't launch, we'll just have you type some things in the chat window. Okay, I'm going to launch the poll. I should be able to do it from my end, so feel free to respond and we're getting some interesting results. We'll share the polling results in about 30 seconds or so. We still see some votes coming in, and we might have some art historians on the line as well. And the key thing about this question is that, obviously, if you're as rich as Warren Buffett, so money is not really an object. All right, I think we have a critical mass. Let me end the polling and share the results, and I'll hand it back to Tyler.
So it seems like the option that got the most votes was nothing. I mean, I agree with that. I wouldn't really pay anything for that either, but that's actually a painting by Jackson Pollock, and it went for, I think, like $200 million. So this thing doesn't really have any value to most of us, but there's still a lot of demand for it. So what if, instead of comparing Bitcoin to investments, what if we compare it to the US dollar? So Bitcoin, of course, is decentralized. It's not subject to any type of government regulation, really. And Buffett criticizes Bitcoin for having no intrinsic value, but consider the US dollar. It also has no intrinsic value, especially if you consider historical events such as FDR's Gold Reserve Act of 1934, or Nixon taking the US off of the gold standard entirely in 1971. And additionally, people in areas with unstable currencies could find value in Bitcoin. And lastly, take a look at the graph in the bottom right that shows the US money supply over the past couple of decades. And it's gone up tenfold, while Bitcoin is fixed ultimately at 21 million Bitcoins, and it will never grow in quantity after that point. So here's a few more sources of Bitcoin demand. Companies such as Tesla, MicroStrategy, Overstock, they view it as a substitute for cash. And other companies like PayPal, MasterCard, BlackRock, BNY Mellon, they're going through some major projects involved with Bitcoin as well. So let's apply these ideas of intrinsic value to this whole GameStop situation. So of course, these traders on Reddit, they of course don't actually go through any calculations of present value, future cash flows. They don't do any valuation. The reason they're investing in GameStop, it's actually pretty smart. They're seeking revenge against the hedge fund managers by buying GameStop. A lot of these hedge funds have large short positions in this stock. And what these Reddit traders have figured out is that there's no force that really ties the intrinsic value of a company to its price. And they figured out that if they bought GameStop in large amounts, they could have pretty big effects on the market. So here's a quote from economist John Maynard Keynes: "The markets can remain irrational longer than you can remain solvent." And it turns out he was right. It takes a while for irrationality to go away. And with that, I'll hand it back to my dad.
Thanks. You're a tough act to follow, and I might have to brush up on my calculus after that. Buffett has also talked about bubbles as well. And another one of his quotes that I kind of like is that a pin lies in wait for every bubble. But as Tyler just alluded to, sometimes it can go on for quite a long time, really years. And I think one behavioral lesson from Buffett here is just don't chase hot performers, right? I asked my colleague Parul, how would you handle trading in a bubble? And the first advice is don't do it. But two, look at the fundamentals if you are going to trade a stock that may get caught up in a bubble. And really, bubbles have been with us since the beginning of time. They're with us since the end of the time. If you're a reader of Buffett's shareholder letters, which I am, he talked about Sir Isaac Newton losing the modern day equivalent of $4 million in the South Sea bubble. And Buffett had a nice little quote here. I'll read the end of it. "For investors as a whole, returns decrease as motion increases." So for most of us, buying and holding, having a long-term outlook, I think makes the most sense, but there are some very successful traders and wouldn't dissuade someone from doing that if they're having success with it. Here's some other interesting insights that we talk about in our book that I think are also just relevant for anyone interested in behavioral finance. We've always known Buffett as a billionaire, I guess, since most of us have been adults, but 99% of his net worth has actually been earned after the age of 50. And I, like many of you, have read the book The Snowball, as well as Roger Lowenstein's great book on Buffett. And they give some data points about how much money he had at each age range. And adjusting for inflation, he'd be a millionaire in his early 20s, shortly after he finished graduate school. You probably know he ran a number of businesses, including farmland and gas station. In terms of the real hard dollar number, $1 million, probably when he was 26, he was running his hedge fund then. But he wasn't really a billionaire until he was about 50. And I think this is a lesson, especially for the advisors on the call, that you want to keep your clients invested for the long term. It's never too early to start saving, and just have the magic of compound interest. Tina Hay did a great job sharing her visual insights about finance, and her favorite napkin was a compound interest. And here we really see it in action with Warren Buffett. Another thing that Buffett is famous for is staying within his circle of competence. And I got to give him credit. He has not really taken the plunge much into technology. I mean, Apple is his biggest holding, but he views that as a consumer stock. His circle of competence includes, I'd say, consumer companies, financial companies, utilities, other things as well. We can see on the left, these are some wholly owned Berkshire companies. I think many of us are familiar with Dairy Queen and Geico and Fruit of the Loom. He has many other companies as well. And this is slightly out of date, but he still has Apple as his biggest holding, Bank of America as his second. We know he just added Chevron and Verizon and a few others, but he bets big. Here's also an interesting quote that I think you might enjoy, and Buffett cites this from Thomas Watson. If you're not a reader of Buffett's annual letters, I urge you to kind of read them. They're on the internet since 1977. And he quotes a lot of people. And here's a quote from Tom Watson, who's the head of IBM during its heyday. I know some of my students may be watching the call, and I describe IBM in the 50s through 70s, maybe mid 80s, as like the Amazon or Google of its day. And Thomas Watson was there for much of that growth. So here's his quote. "I'm no genius, but I'm smart in spots, and I stay around those spots." And that's a lesson for everyone. I think you can stay within your circle of competence, have a chance of doing as well as practitioners, at least within that circle. Buffett was also greatly influenced by his father, Howard, who's shown here in the picture. And Howard was actually a congressman for 6 years in DC. And one of the most valuable things that his dad taught him was this concept of following your inner scorecard. And I guess if I had to summarize it, it's basically don't worry so much about what other people think of you and your decisions. Do what you think is right, what you think is best for your situation, and don't try to keep up with the Joneses, or today I guess it'd be keeping up with the Kardashians. And here's a quote from Buffett. The best advice he's ever been given was from his dad. And he said, it takes 20 years to build a reputation and 20 minutes to lose it. Another interesting quote, you might recall if you're a fan of Warren Buffett, he had a big stake in Salomon Brothers. They got caught up in a treasury bond rigging scandal, and Buffett was forced to be the chairman for a year or two. And his quote is also appropriate. If you lose money for the firm, I'll be forgiving. If you lose a shred of reputation, I'll be ruthless. And I think, as we said, those of us that are in the money management business, your integrity is really important because the client trusts you. Here's a couple other interesting lessons. During one of the trips I went to see Warren Buffett, his license plate literally said thrifty on it. Here's a picture of his home, which he's had since 1958. There's actually an attachment to it on the side, but this is his primary residence. And what you might find interesting, it's literally on the same street that he works, that's less than 2 miles away. And this is the car that he drives. He drives a Cadillac XTS. Before that was a DTS, which is a nice car, but it's not a Rolls Royce. It's not S-Class Mercedes, and he holds the car for a long time. So saving or spending wisely, I think, is important. And I think one thing that may not be completely obvious is that spending less increases your net worth dollar for dollar, while if you earn income, you're paying taxes on that, maybe up to 50% in taxes. Here's some other interesting, more behavioral questions, not really so much financial, but one that I think many of us with kids will eventually think about is how much should you leave for your kids? And here's his quote. Leave your kids enough money so they feel like they can do anything, but not enough that they can do nothing. When the interviewer pressed Buffett for a hard number, he threw out something like a few $100,000. With that, maybe you can help somebody start a business, help pay for college, make sure they're not homeless on the street, but somebody can't retire, especially a young person, on a few $100,000. And one example that he does practice what he preaches, his son borrowed money from Warren to buy a farm, but he was charged market rate of interest. And kind of last tip in our book, and I'll summarize on the next slide, which is also decidedly non-financial. He says, when you get to be my age, you can measure your success by how many of the people that you want to have love you actually do love you. So a decidedly non-financial quote from Warren Buffett. So just to summarize, and we'll move to whatever Q&A we can do. Where should you invest? Well, stay within your circle of competence. If you don't feel you have a circle of competence, that's fine. Just buy an index fund. That's a piece of America. Buffett's a huge fan of index funds. Buy companies with a strong strategic position and barriers to competition. We call that a moat. Don't be swayed by market psychology. We talked about the pendulum. We talked about the inner scorecard. And lastly, as Tyler and I alluded to, and some of our speakers, invest for the long term. Another couple of quotes to end our comments is his favorite holding period is forever. And another rule that he likes, he calls it the 20 punch card rules. Back in the day, Buffett, when he was using computers early on, they had punch cards. So he says, invest if you only had 20 punches or 20 investments in your entire life. I'm guessing if you had 20 investments, stocks like GameStop would not be one of them. So with that, we're happy to answer any questions that you might have. Ron, if you can look for any questions, if you're with us.
I am with you. Just getting all my stuff together. Well, this is not a question, but one of our fellow professors wants to know if Tyler will teach your corporate finance class. I just wanted to get that out there for you, Tyler. So here's a thought. Do you think that Warren Buffett would have the same perception about Bitcoin, even though Tesla has bought 1.5 million of it and plans to accept it as a payment, and other companies may follow suit?
Yeah, it's a good question. To me, a seminal point would be if Amazon and Walmart accept accept Bitcoin. Because if you're Walmart or Amazon, you have like a 3% profit margin. So the day-to-day movement in Bitcoin could wipe out those profits. Tesla, in contrast, is selling a car that in many cases costs over $100,000. So I do think it is gaining increased acceptance. Tyler alluded to PayPal and MasterCard, which are massive companies that are doing it. But at the end of the day, it does not pay cash flow. So I don't think he'd be a big investor in it, even though we may see it continue to increase.
Great. Here's another question in the Q&A. Are there areas where Buffett's personal strategies deviate from orthodox behavioral finance?
That's a good question as well. Buffett, if you know Buffett, he prefers to buy companies completely as opposed to buying the stock. Most of us know him buying stock like Apple and Verizon and Chevron. And what he says is that I'm going to buy somebody's business, and that may have been their baby, so to speak. And I'm going to hold on to the company, even maybe losing money. Great examples are Berkshire itself. For many years, he reinvested in the losing textile business. Another one that he still holds is World Book Encyclopedia. We used a couple of pictures of Wikipedia for this. So I think Buffett has he does practice what he preaches. He has an exceptionally long horizon, which many money managers such as myself cannot do. And another quote that I like in his annual report, he cites Ted Williams, who is perhaps the greatest baseball player of all time. And Ted Williams broke the strike zone into 64 cells and realized that if he only swung at pitches in certain cells, he'd bat 400, and those other cells he'd bat, let's say, 240. So I think he is really disciplined, and that's one, I think, great strengths of his. I'm also amazed at how few value traps he's invested in. Companies like Kodak, for example, he's never went in. But he does make mistakes, and we all do. And I think that's one reason why he's holding so much cash. He's not really putting things in SPACs. And I know he's Snowflake, but that's probably one of the people beneath them.
Great. And here's a one last question. I think we're hitting the time. That's a great question. Buffett says, stay in your area of competence. How do you help younger investors not overestimate their investment confidence?
Let me give that to Tyler. What advice would you have for younger people, just investing in general or just behavioral finance?
I guess the advice I would give is, I guess, think through any investments you make carefully. Like, for example, a lot of people my age are like pretty excited about Tesla, and they don't really realize that everyone's excited about Tesla. It has a forward PE of like, I think 150 last time I checked. So I think it's really important to always think of things in the perspective of the entire market.
Good advice.
Great. Great job, guys. So I think it's always good to hear stories of Warren Buffett, and I know it's near and dear to John and Tyler's heart. So thank you so much for doing that. So as we get into the very last stage of this conference, again, we had hoped to get people in breakout rooms, and the technology just isn't allowing us to do that. But we do want to pose one more question, or a prompt that we did earlier. And at the very end, Max, if you're there, at the very end, we did get a request for someone to put the CE credits again at the end for the first half and the second half. So we'll do that at the very end. I saw that in the Q&A area. But let me share with you this prompt. Let me get it up on the screen. And this is your opportunity. We're going to ask people to maybe raise their hand, and we can get your thoughts on this. And this one I think is very interesting. Let me share with you on the screen. So here, if you could see it now, the question is, as our icebreaker prompt, and again, thank you for hanging in with us all day on this behavioral finance conference. We'd like your thoughts on what you think parents should teach their kids about finance and behavioral finance. So if you're one of our college students who's more on the younger side on the call, you can speak to what you maybe hoped your parents would have taught you or what they did. And people of my age group, I can give you thoughts that where I think I've been successful or unsuccessful. So please raise your hand and we will let you speak. Okay, I got the first one here is Ahmed. I'm going to allow you to talk if you would. Go ahead, Ahmed.
Hi,
Hi.
I'm Ahmed from Iran. I think the most important thing is budgeting. Budgeting is very important for those who want to start their life. Actually, I'm 27 and I spend money like there is no tomorrow. So,
Ahmed, my father used to say the money used to burn a hole in my pocket. That's why I spend it so fast. So, okay.
I think that's great advice, Ahmed. I mean, the magic of compound interest can't really work for you unless you're in the black. And some of our panelists have talked about paying yourself first. And it's hard, you know, we're bombarded, teenagers like Tyler are bombarded with social media, people with a flashy lifestyle that few people can afford, especially teenagers. So having that mindset, and this goes back to what we talked about Buffett in the inner scorecard, he doesn't really care so much about what people think. He still has McDonald's for breakfast most days. One funny story that we mentioned is that Buffett actually took Gates out for lunch at McDonald's, number one, and number two, they paid with a coupon. So having that mindset of saving and letting compound interest, and some really great visuals on that in Tina's book.
Great, thank you, Ahmed. So next on is Graham. Let me unmute you there, Graham.
Hey, Professor. Pleasure being taught by you in undergrad and in graduate school. I'm about to graduate here, and I did purchase your book. So if I ever get to see you again in person, I'll be sure to get you and your son to sign it.
Thanks,
to answer the prompt question, I think you had just alluded to it, but absolutely you should teach your kids about finance. Like you mentioned, time value of money or that compounding interest. If you can really instill that in your kids at a young age, it gives them more time to compound that and be wealthier later in life, as well as just like the person before me alluded, for budgeting, it is very important. As far as behavioral finance, I think it's now more important than ever, with the rise of retail investors through these fintech companies, as well as things like Reddit and the mob mentality that comes from that. You can really get swept up in the craze, like such as GameStop or AMC, which if you did look at the fundamentals of the technicals of those companies, they tend to be very poor companies that have, shot up or to the moon based off of just supply and demand rather than the actual underlying value of the asset. So if you could instill that in your kids at a young age, you could protect them from falling victim.
Thanks, Graham. I agree with everything that you said. And just to kind of put a plug for yourself, in my value investing class that Graham was a part of, he correctly said, let's buy some Carnival if you have a long-term horizon, after the stock went down 80% after the pandemic. And since that recommendation, the stock is up around 50%. So having that long-term horizon, doing the budgeting, all the things that people have talked about do pay off. But sometimes it's lonely waiting for a long time, like Buffett, just kind of playing baseball and not swinging at any pitch.
Great. Let me get Lauren.
Yes, hi. I have really young children, so it's a little bit different on my end, but what we've been doing is teaching them about budgeting, and what's really been a great help with that is that new Greenlight app, and they just rolled out an investment piece. So we're teaching them, to set goals and save their money, and then to invest a portion of that. So we're kind of doing a 10% invest, 10% charity, and then 80% for their own savings goals. It's been really exciting to see how into it they are. And I'm talking from 6 years old to 12. So it's pretty neat.
That's a great story, Lauren. And I really like the part about the charity as well. And, I'll pose this to Tyler in a second, what age should kids get started? But I can just share our experience that the first stock he bought, or I kind of bought it for him, was Disney, because we took family vacations there. He enjoyed this experience. And then as a teenager, I think he followed the markets more. And like me, he bought Bitcoin, but he also bought DraftKings and some other things as well that have done well. So I think the Peter Lynch approach of investing in what you know, I think kids can grasp that. I had also a great example about, think about a company you like and its logo. I thought about Nike and immediately thought about the swoosh logo. And I think kids can grasp that as well. Tyler, what do you think? Any thoughts on what age should kids start? Is there any age?
Yeah, I think as soon as kids can grasp the ideas of, I guess, basic supply and demand, like economic transactions, how that stuff happens, I think that's as young as they can understand that, I think is a good time to start investing. Great,
thanks, Tyler. So just a quick story to, because you want to incentivize people to have those behaviors. My brother did an incentive with his oldest son, who's 17, that when he wanted him to open up an IRA, but his son obviously didn't want to put all his money in the IRA because he wanted to spend some now. So they made their own family match. Like companies have matches, so they made their own family match. So he matched dollar for dollar for what his son would put into the IRA, up to whatever the IRS limits are. But the idea was to incentivize him to get into that behavior. And I thought that was a great approach to teach someone of a young age the idea of saving for retirement. At 17, 65 seems like a long way. Okay, Ingrid, we have Ingrid back. Ingrid, you're all up.
Can you hear me now?
Yes. Yes.
Okay, my headphones are not working. I think I already have a 20 years old son, and something that I learned from him is when we teach our kids they are responsible of their own finance since young age. They can be successful. I see many people in their 30s, under 20s, that they are still depending on their parents. So I think that it's important that we teach our kids in young age, like even younger than teenagers, they have to be responsible of their own finance. I see people who go back to their parents' home, even with a degree, with a career, I see a lot of that. I don't know if happened only in my area, but I think it's because they believe that their parent has to support them forever. So I don't know, it's something that I see a lot. So I don't know if maybe teaching our kids to be responsible of their own finance in young age, so it can help them be successful in the future.
Yeah, but Buffett had some insight on that. As I mentioned, his son was a farmer and needed money for the farm. And Buffett said, okay, I'll give you the money, but I'm going to charge you what a bank would charge you. So I think telling them that, you know, if you have money, there's strings attached to it. You're not going to be able to sit on the couch all day and play video games. I think people will get the message at some point.
Great. Okay, we still have a couple more coming in here. Velarde, if I said that correctly.
Yes, hello.
Hello.
How are you? Thank you so much. That's been a wonderful conference. I've learned a lot, and now I would like to give my opinion in terms of, first of all, being a mother of 2 teenagers. And I think the best way for kids to learn is through the example of the parents. And not only in terms of like investing and savings, but also how you use your money, like not being afraid to, I don't know, use coupons when you have them. If you have a way of saving, not being afraid of doing that, right? Like teaching them that they have to live within their means. And that is a very important lesson, especially nowadays in society when I think one of the panelists was mentioning about like, okay, my neighbor bought the last model of this car. And so not to teach them that it's important that they will keep up with the herd, as a way of saying, but being able to live within your means and being able to be, thoughtful about how you can grow in the long run, and not only saving for a specific thing, but for the whole goals that they have in life.
Yeah, thanks, Velarde, for those comments. And if Warren Buffett and Bill Gates can use coupons, I think we all can. And I think one of the great benefits of advisors like Ron and many people on the call is that you're helping your clients set those goals and make progress towards those goals and tracking them on a regular basis. And that's, Vanguard wrote a paper called Advisors Alpha. You can kind of search for it. And I think there's really real value in advisors with that. I don't want to add anything to that, Ron.
Okay. Nope, I'm good. I'm all good with what you said. All right, so now we have Michael. Michael Haas, if you're there. Michael, you there?
You're there, Michael, and having sound issues, feel free to type something in the Q&A box and we'll try to take a look at it.
Right. All right, we'll try Shweta. I see Shweta had her hand up. Go ahead, Shweta.
Hello?
Yes, yes, Shweta.
Yeah, hi. Hi. First of all, I'd like to start by thanking you for hosting this conference. It's been a great experience. So one of the things that I have kids that are little, my old.
We can hear you, Michael, but we'll come back to you after Shweta. Please continue.
Yeah, so my kids are tiny. The younger one is, less than 2 years old, and the older one's 7. But something that I'm trying to learn, going off of the other points where you get them started as early as you can about the concepts of investing, is I think it's a lesson for me to learn, and something that's going to be difficult to do is to let them make mistakes early on. I'd rather have them lose all their savings or investments, so to speak, at a younger age than at a much later age. I think it sort of gets them used to the idea of investing, but also, the risks are something to be cautious about, but not something to be so terrified about that you don't do it. So that's something that I think is an important lesson that I'm going to try and teach my kids.
That's great advice. And you know, as you mentioned, if you're losing money when you have a few $100s to invest, it's better than losing it when it's hundreds of thousands. And Buffett advice that he says, try to learn from your mistakes, but also try to learn from the mistakes of others. And he has this quote about trying to act as if all your actions would be shown on the page of your local newspaper. Today, it might be Snapchat or Facebook. And obviously, sometimes we do impulsive things, but overall, think like that, you'll be a lot better off. Michael, we can go back to you if you can try to unmute your mic.
Michael Haas, if you can unmute your mic and you can give us your thoughts. Mike, are you there? Michael Haas?
You may still be having an issue. If your mic is back, Mike, you can just keep it on, and then after the next person, we'll keep you in the loop.
Great. Okay, I'm not seeing anything in the chat. Okay.
I see a couple of things. So the Vanguard article that I mentioned is called Advisors Alpha.
Actually, reading some things about Jack Bogle is also very enlightening for investing too. So if you're talking about Vanguard. Good.
So Michael typed something in the chat. He had a sign.
I do see that.
Able to hear you. What are some of the best books you've read about Buffett's philosophy? So I see that in the chat. My favorite book is the Roger Lowenstein one, Warren Buffett, The Making of an American Capitalist. I think that gives great insight into his early age and his mindset of buying companies. Obviously, The Snowball by Alice Schroeder is the only book that had his cooperation, and that's massive at around 700 pages. There's also a book called Buffetology, written by the ex-wife of his one of his sons. And I don't know the details on it, but I don't think Buffett was maybe thrilled with that book being published, but there's some insight. Tyler kind of alluded to Buffett looking at companies with a moat and taking the present value of those cash flows using a long-term treasury. So Buffetology be one, The Snowball, Roger Lowenstein, and if you have somebody younger, hopefully they'd enjoy our book as well.
Okay, I think we have time for maybe one more and then we'll probably close it. Is Kaminia there? I'm going to allow you to talk, Kaminia.
Hi, yes, I'm here. Thank you very much for letting me participate. I just wanted to say that we are working actually in financial health, in trying to build in proper financial habits, and we are actually approaching it from the behavioral economics perspective, from the cognitive sciences. And one thing that we have found, and we are keeping on finding, is the fact that treating financial health and something holistic that has different parts, like how to build a budget, how to save for short-term goals, how to do long-term objectives, how to bring long-term objectives to the present through credit, how to insure yourself properly. It brings some sense of and some availability of using hooks in order to use with kids. And that is incredible because we are able to nudge them towards, for example, long-term savings through allowing them to save for short-term objectives that they might want to attend. For example, someone saving for their own dress of Frozen, or someone saving for a bicycle, those type of habits, and working especially to get them, like their parents can give them more money for different activities that they perform. Those healthy habits in relation to money, and the conversation that becomes money becomes something healthy then with their parents, then this allow us to work towards more long-term objectives and teaching them other things, like for example investing. I just wanted to share this with you guys. Thank you very much.
Right. Thank you, Kaminia.
Thanks, Kamina, for those comments. I think you're spot on. And Michael, who was having some audio difficulties, did type his kind of comments in the chat box. And if you read some of the background on Buffett, he actually had his first business venture when he was 5 years old. His grandfather owned a supermarket, and Buffett would buy packs of gum and resell the pieces. And Michael's point was that even if somebody 5 can understand this notion of buying a product and selling it, and then he later went on to putting pinball machines in a barber shop and splitting the profits 50-50. So a young kid clearly may like playing pinball machines. And then the next extension of that conversation is, okay, how can somebody make money with it? There was a question on the window on the Robert Hagstrom book, The Warren Buffett Way. That was also a good book. It was the first, I think, million copy seller. That book is good to give you some insights into Buffett's strategy. One thing he likes is companies with a lot of free cash flow because he can reinvest that free cash flow. So thank you for that other book.
Great. So with that, John, I'll say a couple words. You can say a couple words, and maybe we can end it with Max putting up the 2 slides. But I want to thank everyone for coming. I want to obviously thank all the people that played a role in this. You guys keep hearing the word Max. Max is our tech guy. Without Max, we could not have done this. But I also want to thank all the people who had spoken, the panelists and the guests that we've had come. And I also want to thank John and his son for at least having me involved in it. So thank you so much.
Well, thank you, Ron, and for everyone for joining us. I'd echo your comments. Thanks to the panelists and speakers and Max for the tech support. And this is really a fascinating field that I think we all enjoy. And when Ron and I were planning this conference, we were kind of thrilled to get somebody like Richard Thaler. And I think all of our practices and really lives are better off with the contributions that he and Kahneman and Schiller and others have made. So, keep doing what you're doing. And we plan to post the conference at some point on the Rutgers web, let's say the YouTube channel, and you can come back to it and feel free to reach out to us. Ron and I are both accessible via email. And on behalf of Rutgers Business School, thank you for joining us, and best of luck health and wealth-wise. So thanks and have a great day.